So, Physics Wallah, the edtech giant that pretty much everyone knows from YouTube, is finally going public. They filed their official prospectus, and in this breakdown, we're going to tear into that document slide by slide to really understand the business, the numbers, and most importantly, the big risks. Okay, let's get right to it. This is the big question on everyone's mind, right? To get an answer, we have to look past the hype and really dig into the hard data that the company has handed over to the regulators. First up, just let this number sink in. 15,775 employees. I mean, to put that in perspective, that's bigger than a lot of established IT companies. This shows you we're not talking about a simple YouTube channel anymore. This is a massive industrial-scale operation.
So how does this whole machine actually run? I mean, before we even touch the financials, you got to understand the core business model that got them to this point.
It all kicks off with a really clever freemium model. They give away a ton of fantastic content for free on places like YouTube. This builds up a huge, loyal following that basically acts as a giant organic sales funnel. Millions of students get drawn in, and then PW can upsell them to their paid, more structured courses. It's a brilliant way to keep the costs of finding new customers super low. And they're not just making money from online classes anymore, not by a long shot. They've branched out in a big way, pushing into physical coaching centers, selling their own books and study materials. They're even running student hostels and collecting fees from franchisees. This strategy is all about growth, but you gotta remember, every new venture adds a layer of complexity and a whole lot of cost. And that right there reveals the central tension in their whole strategy. On one side, you've got their digital business. You can scale that to millions of users at almost no extra cost. But on the other side, you have this huge, expensive bet on physical offline centers. The entire investment case really boils down to this. Can they balance these two opposing forces without one of them dragging the other down? All right, let's get to the juicy part, the money. The financials tell a pretty classic story for a tech startup that's growing like crazy. Absolutely mind-blowing growth. But there's a pretty significant catch. First, the good stuff. Just look at this growth on the top line. Revenue shot up from around 7.4 billion rupees in 2023 to nearly 29 billion just 2 years later. That is absolutely staggering, and it proves there is incredible demand for what they're selling. But here's that catch I mentioned. Even with all that revenue pouring in, the company still posted a restated loss of over 2.4 billion rupees last year. So the growth is definitely there, but profitability? Not so much. This table really lays it all out. You can see the revenue climbing like a rocket, but then look at the expenses, they're climbing right there with it. And check this out. The loss actually got way worse in 2024 before they managed to bring it down a bit in 2025. So where's all the money going? Well, the prospectus points to a massive spike in employee costs and marketing, which makes sense given their big push into offline centers and the battle to hire the best teachers. The key takeaway here is pretty clear. This company is buying its growth, and it is costing them a fortune. You know, a company doesn't just exist in a bubble. So let's zoom out for a second and look at the bigger picture, the edtech industry, to see what kind of battlefield Physics Wallah is fighting on. The education market in India is just enormous, with K-12 and higher ed taking up most of the space. Now, Physics Wallah's main playground is in that smaller but incredibly competitive 6% slice, test prep. Sure, they're moving into other areas like upskilling, but test prep is still their bread and butter. And that market is what we call highly fragmented. They aren't just up against other big edtech names you've heard of. They're also fighting established national brands, really powerful local coaching centers, and literally thousands of individual tutors. It is a war on all fronts. So, all of this leads us to the IPO itself, and honestly, what might be the most crucial part, the risks. The company is legally required to list out all its weaknesses in the prospectus, and it's something every single potential investor needs to read. And this number is probably the most shocking one in the entire 500-page document. In 1 year, their faculty attrition rate was over 40%. That means 2 out of every 5 teachers they employed left the company within 12 months. That's just staggering. So you might be asking, okay, why is that such a huge deal? Well, in an education business, your teachers are the product. A high turnover rate isn't just a headache, it's a direct hit to the bottom line. It means you're constantly spending money on hiring and training, you risk your teaching quality becoming inconsistent, and that can damage the very brand that pulls all those students in. When a START teacher leaves, their students often follow them right out the door.
And that crazy attrition rate is just the tip of the iceberg. The company flat out says they are heavily dependent on keeping their star faculty. They also mentioned the intense competition we just talked about, and now there's growing regulatory pressure on coaching centers. All of this is happening while they're trying to figure out how to run this new, super expensive offline business that they have very little experience with.
Okay, so let's quickly look at the deal. The IPO is a mix of a fresh issue, which means new money is coming into the company, and an offer for sale, which is where some early investors are selling their shares and cashing out. The money the company raises is going to be used for exactly what we've been talking about: building more offline centers, upgrading their technology, and maybe even buying other companies.
So, after all that, where do we stand? Let's put everything together and look at this from two sides: the bull case, the argument for investing, and the bear case, which is the argument against it. Look, the bull case is really compelling. You've got this massive, beloved brand with a huge online community, absolutely insane revenue growth, and a business model that's tapping into a giant market. But the bear case is just as powerful. The company is consistently losing a lot of money, teachers are leaving at an alarming rate, the competition is brutal, and there are some really big risks tied to new regulations and their big bet on offline centers.
Ultimately, what we have here is a classic high-growth, high-risk investment. So the final decision isn't really about whether Physics Wallah is a good or bad company. It's about what kind of investor you are. Are you the type who's willing to bet on explosive growth and brand power, even if it comes with some very serious financial and operational risks?
And of course, please remember, this breakdown is purely for educational purposes. It's all based on the company's official filing and is not financial advice. We've gone through the data, but you absolutely have to do your own research before you make any investment decision.